Good morning, everybody. I'll make it around about 11:30. There's still a few people joining, so I'm just going to check. Last time I did one of these webinars, I did the first 5 minutes without the sound on. So if you can't hear me, drop me a message on the sidebar on your screen. Let's just kick off with a little bit of what you'd call housekeeping if you were in the real world. So this seminar is going to be covering the share incentive plan and all employee share plan. My name is Sarah Anderson. I'm a director at RM2, which is a specialist share plans advisor, and I'm a solicitor who's been working in share schemes for going on 20 years now, mainly focusing on share plans for private companies. This presentation will last for around about 30 minutes. You can send questions on the bar, and thank you very much, Julian, for saying you can hear me. That's a great relief. We'll be making a recording of the webinar available on YouTube should you wish to watch it again, and perhaps if one of your colleagues wants to hear it, you can share that with them. And then my details are there if you want to get in touch with me with any questions after this session. The easiest way to get hold of me at the moment is email, because we are not in the office, but we will be back in the office soon, fingers crossed. In the meantime, email is the best way to send me questions, or just get in touch. So to start, the webinar is really supposed to be a practical introduction. It's not supposed to be particularly technical. I'll be just talking about the key benefits of the share incentive plan, or SIP. I'll talk about the main benefits of it, the key requirements that you need to make one work, and how you set one up, and then how you administer it afterwards. And I'll explain how the scheme works, including a practical example of how it worked for one of our clients using a case study. So to kick off, what is a share incentive plan? Well, it's government recognised, it's tax advantaged, and it's very well established. It's been around since 2000. Used to be known as an approved scheme, but now these types of plans are known as tax advantaged, which is a very good description for the share incentive plan, because if it's used correctly and the rules are followed, it can result in zero tax rates, both income tax and capital gains tax, and that's for the participants, as well as zero NICS rates for the company and the employer. So it's a very, very tax efficient scheme, and obviously there are certain rules you have to follow to get that level of tax advantage. So the key thing is that the SIP must be made available to all employees in a company. It involves actual shares which are held in a trust rather than share options, so there is a sense of real ownership there. But within those limits, it's actually a very flexible model in the way it works, because it allows shares to be gifted to employees or bought by them, and it also incorporates a bog-off arrangement, actually a buy one, get two free arrangement, whereby if you buy one share, you can get up to 2 matching shares free. The plan's intended to encourage long-term motivation and reward for employees. The legislation actually states that it is intended to provide employees with a continuing stake in the company. So if that's your aim, then SIP really is your go-to plan. So while you should never really implement a share plan just for tax advantages, it is undeniable that the SIP is absurdly tax efficient. So there is no income tax or national insurance contributions to pay when a share is gifted to an employee. If the employees buy shares, they buy them out of pre-tax salary. When the shares are sold, assuming certain rules are followed, there is no capital gains tax to pay either. So from the company's perspective, no NICS includes employers' NICS as well as employees, so there's a saving for the company as well, which can be significant. And in addition, there are the usual corporation tax relief for the company that can claim a deduction for the costs of setting up and running the plan. And there are also potential capital gains tax savings for example, founders who sell their shares into the SIP. Obviously, certain rules apply to those tax reliefs, but there they are, and they add to the more obvious ones of income tax, national insurance contributions, and capital gains tax exemptions that apply to this scheme. Leaving aside the tax benefits, there are various other benefits attaching to the plan, and I think the key one really is its flexibility, because it does allow your employees to acquire shares in a variety of ways. The first way is by employees being gifted shares, each employee in the company, so there's no company limit. Each employee can receive up to £3,600 worth of shares each year, free of income tax and national insurance contributions. There isn't really another way of giving shares to employees in the UK without either them paying for their shares, paying the market value, or paying an income tax charge on the value of the shares that they receive. So that is a very, very beneficial way of awarding employees free shares if you want to do that. In addition, employees can buy up to £1,800 worth of shares out of pre-tax salary. Those are known as partnership shares. And for each partnership share that they buy, they can get up to 2 further shares called matching shares, which again are free of income tax, free of national insurance contributions. So that gives you a maximum allowance per participant each year of £9,000 worth of shares, and the only thing that an employer would pay for that is the pre-tax salary payment for the partnership shares. So that's the key benefits of flexibility. The other point, and this I think is very important for employees in private companies, because private company owners obviously are often very concerned about the control of their business. They may wish employees to share in the ownership to a degree, but they don't really want to give up ultimate control a lot of the time. So you can use a non-voting share in a share incentive plan if you wish to do that, which will ensure obviously that you, as the founder shareholder, keep control of your company. You're not obliged to carry on giving shares under your SIP forever and anon. You can time your awards according to what the company wants to do. So you can, if you want to, just give a one-off award to say thanks to employees. So there's always control over how often you're going to give shares, and you can also limit the number of shares that employees can acquire at each award. So you're never going to be giving away any more than you want to give away under a share incentive plan. You decide that at the outset, and as you go along, it's entirely up to you. You've also got the ability to forfeit free and matching shares if employees leave the company, if they cease employment. Obviously, it's typical. I mean, it doesn't always happen, but it's very typical for a private company to make sure that employees who acquire shares and then cease employment give the shares back to the company when they've left, or in this case, might give them back to the share incentive plan itself. So under the share incentive plan, you can forfeit the shares that you give them free. The SIP trust might have to buy back the partnerships because the employee will have paid something for them. So a leaver can be required to sell their shares back if they've paid something, if they cease employment at any point. And those shares can then be taken back by the SIP trust and recycled for future awards. So those are the key benefits of the share incentive plan. You've got the tax benefits, you've got the flexibility, and you've got the sense of safety for the founder who need not give away control of his company just because he wants to his employees to benefit from some form of share ownership. I want to move on to some of the key requirements for a SIP plan. The first thing you need to know is that you need a SIP trust and trustees to run it. The trust, importantly, has to be UK based, so it can't be offshore. It holds shares on behalf of all of the employees, and it does need to operate within the bounds of the SIP legislation. So it doesn't have discretion like some of the other employee benefit trusts you might have come across. Crucially, it always has to act in the best interests of the beneficiaries of the trust, i.e. the employees. So it's quite common to have an independent professional trustee running a SIP, especially for larger companies, to make sure that they don't fall foul of those rules, and they're aware of that very crucial point that you must act in the interest of the beneficiaries. And of course, an independent trustee has that sense of independence, and there's going to be less concern about conflicts of interest. If, for example, your founder is the trustee of the SIPP trust, you need to make sure that he's not inadvertently acting in his own best interests or in the interests of key employees or something along those lines. You need to make sure your trustee is acting properly within the scope of the legislation and within the scope of trust law. So that SIPP trust, once it's set up, it does have some specific advantages apart from the tax advantages I've noticed before. Using a trust in a private company is a good way of ring fencing a certain proportion of shares for employees, so it can recycle leavers shares. So a leaver, an employee ceases employment, sells shares back to the trust, and then the trust uses those shares to make a future SIPP award. And that's much easier than going through the rigmarole of issuing shares and then buying them back from leavers and cancelling. So that's where the SIPP can be used as an internal market for employees as well. And there's going to be an example of how one of our clients did that a little bit later on in the presentation. Of course, the most important thing, or one of the most important things again, is that for as long as the shares are kept in the trust, any gains on those shares are entirely free of capital gains tax. So actually for the employees, there's very little advantage in taking the shares out of the trust and putting them into their own names, because that would remove that capital gains tax shelter for them. Some other requirements. The key one is that the SIPP must be offered to all employees in the company. And just to repeat that, the main purpose behind the plan is set out in the legislation. It must be set up to give the employees a continuing stake in the business. And of course, the avoidance of tax must not be one of the main purposes of the plan. In terms of making it available to all employees, if you've got a group of companies, you can include some but not all of the subsidiary companies. So for example, if you've got overseas subsidiaries where the tax benefits aren't going to work, or if there are issues in giving employee shares and tax nasties in overseas jurisdictions, you don't need to include those subsidiary companies in your group SIPP plan. Employees must participate on the same terms. That doesn't necessarily mean you have to give all of your employees exactly the same number of shares, but you do need to make sure that you don't end up giving higher paid employees more than other people. The higher paid or directors mustn't be the main beneficiaries of the plan. You can vary the number of free shares given by reference to certain measures, specifically hours worked, salary, or length of service. You need to be, again, just be careful that with the way you work out those levels of reward for a free share, you're not inadvertently, again, benefiting those highly paid employees. So for example, if you said, I want to give one free share to everybody earning up to £20,000 and 40 free shares to everybody earning over £100,000, that would be a little bit disproportionate. So you need to just, usually we work out a points-based system, so you make sure that the levels are reasonably fair amongst all the different salary levels. And in terms of benefiting higher paid employees, directors, the partnership shares, of course, people are buying shares of the partnership shares, so it's almost inevitable that somebody who is higher paid will be happy to spend more money on shares in their own company, potentially, than happier than a lower earner, at least, because they've got the spare cash to take that risk, however small it is. But because the annual limit for partnership shares is £1,800 a year, it's quite difficult to massively and disproportionately benefit higher earners under that. So there's a natural cap under the legislation that prevents you breaking those same terms rules with a partnership share. You can set a qualifying period of 12 months before employees are invited to participate. So if you set a scheme up, don't feel you have to give shares to somebody who's only been with you a week. You can wait for them to complete their first 3 months service or up to 12 months service. And do note that majority shareholders can also participate as long as they're employees. In fact, you must offer the SIPP to even the majority shareholder, even if he's the founder, if he's an employee of the business, otherwise you will be in breach of the rules of the SIPP. One of the points I think I haven't mentioned yet, although it is important, is that SIP is a long-term plan. The maximum tax benefits will only accrue at the end of a 5-year period. And if shares are taken out of the plan before that time, then there might be a clawback of the tax benefits. So, for example, an employee isn't charged to income tax when the shares are first given or to them, or if they first buy them. But if they leave, for example, within 3 years, or take the shares out of the trust, there will be a clawback of income tax potentially next, but let's just concentrate on income tax. And that will be charged from the market value of the shares when they're taken out of the plan. The kind of sliding scale, so if you take the shares out of the plan between 3 and 5 years, the charge is based on the market value of the shares at the date of award or the date they're taken out, whichever is the lower. But there will be no clawback if an employee is a good leaver, which is set out in the SIP legislation, typically somebody who is made redundant or becomes too ill or too disabled to work. Those typical good leaver provisions that you see in tax legislation a lot. If they leave for another job, they're usually a bad leaver, so you get that clawback then. There won't be a clawback if the company is sold, usually for cash consideration. That's an exit event, which lots of private companies are looking for anyway. So you don't get a clawback of tax if that happens. And then going back to that 5-year period, if you've left your shares in the trust as an employee for 5 years or more, there cannot be any clawback of that income tax that you've benefited from at the outset. Let's talk about setting the plan up. There are, like life generally, some must-haves and some nice-to-haves. So I would say you definitely need the following things. A design blueprint. So you need to think about the percentage of equity you're happy to give away, what kind of shares you want to use, non-voting or just ordinary shares that everybody else would normally hold in the company. Some kind of timetable, so you've got an idea of when you're going to be making those awards. And do bear in mind, you can't set up a SIP plan overnight. It will usually take a few months, partly because of the design, partly because you are going to be making awards to lots of employees usually, and partly, and very boringly, because one of the things you need to do is open up a bank account for the trust, and banks are really slow. So you do have plenty of time while that bank account is being opened to think about the design of the scheme. For a practical point of view, you will need a set of plan rules, which will set out broadly how the scheme works, and make sure that you're complying with the SIP legislation. You will need a trust deed, and you will need a trustee, which, as we've discussed earlier, you need a trustee to operate the trust, because it's the trustee's job to make the share awards to employees and to hold the shares on behalf of the employees and to buy shares back from the leavers when you need to do that. And because the trust needs to act within the rules of the SIP and within the confines of trusts law, it can be sensible to have a set of trustees who have a real understanding of the law and what they need to do. So again, you're going back to the concept of an independent, potentially corporate trustee that's quite used to operating SIPs for companies and can make the procedure smooth for you, the company owner, and know that while it has to take instructions, for example, from the company directors will say, we'd like to make an award, trustees, and the trustees will normally say, that's absolutely fine, thank you very much, directors, we will do this. But if, for example, the directors resolve to make an award only to certain key employees, the trustees need to know enough to say, sorry, directors, you can't do that. This plan is for all employees and you must follow these rules. So again, a trustee who kind of has an idea of what they're doing is quite helpful. I've mentioned the bank account. You probably also, so the reason you need a bank account is that the trust is going to have to be funded by the company. It obviously doesn't have its own money. And specifically, it will need money to subscribe for shares in order to make the awards for the employees. So that's what you need the bank account for. And it might also need funds to buy shares back from leavers, depending on the value of the shares. If you're using a partnership share arrangement whereby employees are buying shares, then the trusts will use the employees' salary contributions to buy those partnership shares. whatever the cause, there is money going in and out, and the trust needs its bank account to do that. Approval of shareholders and board resolutions. It's advisable to get shareholders' approval to establish a SIP, and it would certainly be very normal to have a board resolution to confirm that the plan has been adopted and recording when awards are to be made, including giving instructions to the trustee. There will also be resolutions, or at least records of the trustee decisions. So if it's a corporate trustee, it would usually be in the form of a board minutes or a board resolution. In addition to the rules, you need partnership and free share agreements, depending on what offer you're making. So each employee has to enter into an agreement to say, yes, please, they would like to participate in the SIP offer they've been invited to. If they're going to buy partnership shares, they need to agree how much money they want to set aside to buy the partnership shares, which might be a one-off payment or on a monthly basis, saving over the period of a year. And the agreements also contain various bits of information about, for example, what happens if they cease employment. If the employees don't complete an agreement and send it back to the trustees, then they won't be able to participate in that particular SIP offering. Probably also want employee communications documents. At the very least, you need a set of like FAQs and a summary of what's going on. Some companies, depending on the size and the number of employees, will do a full communication strategy, which might take, several weeks or months. Maybe starting off with a kind of a teaser pack saying, oh, we're going to be planning to be doing this, and then potential full kind of all hands meetings. Very much down to your workforce and how, for example, financially astute they are. But like all shared plans, the better you communicate to your employees about them, they tend to be more successful. So that is something that is, in my opinion, it's more of a must-have than a nice-to-have, because it will make sure your share plan works better. Lastly, for any share incentive plan, because especially if you've got lots of employees, you need a really well-organised payroll so that you know all the details for salary contributions for partnership shares, and also you've got a really clear idea of who's joined when, who's left when, and why they've left. So that's really important. Things you might benefit from is potentially changes to your articles to cover, for example, employee leavers and so on. Potentially some equity modelling to work out exactly how much you want to give away and how that might pan out over a 3, 5, 10-year period. The independent trustee administrator, I think I've laboured that point enough. And the detailed communication strategy we've already discussed, very much something that's tailored to your workforce rather than a kind of standard template document. So I just thought about I just wanted to sort of just run through really quickly how it will usually work. So first of all, the company sets up the SIP trust and the plan rules. Then the company invites the employees to participate. So you send out your free or your partnership share agreement to employees to say, do you want to join in? And they have to accept, the employees have to accept that share agreement, including agreeing to make a salary deduction for partnership shares. At that point, the company issues the shares to the trust or the funds to the trust, or in some cases, the founder might sell some shares to the trust and the trust might buy the shares. And then the trust just sits on those shares and holds onto them on behalf of the employees until such time as an exit, or employees leave, or potentially employees say, actually, I really would like to sell some of my shares, I'd like to take them out. And while that is going on, dividends can be paid to employees, and shares from leavers will be sold back to the trust and recycled for future awards. So that's a kind of really basic step-by-step explanation of how the SIP trust works. In terms of, I think this is quite a good example of why a trust, which on the face of it might look complicated, is potentially more straightforward than individual employees holding shares. Because of course, if an individual employee holds shares, you've obviously got a share certificate. The shares are issued to them. When they sell their shares, you're having to make sure you get their shares back from them, transferring shares from individual back to company, cancelling shares. Most of the time with a SIPP trust, there isn't any of that involved. You just reallocate the employee's shares, and kind of just notice that it's no longer a share belonging to Bob, but it's a share in the general pot. The shares just stay in the trust anyway. It's just they're labelled differently. And the SIPP trustee writes to the leavers saying either you've forfeited shares or here's pounds XX for the shares that you had a right to and you've now left. So it's a much, from that perspective, it's an easier administrative process than individual shareholding, in my opinion. So you set up your plan, you've gone through all those steps, you've got a trust, it's holding the shares, everybody's happy. There are ongoing administration requirements for any share plan. So once the first awards are made, the company needs to register the plan with the revenue on their online employment-related security system. They need to fill an annual return in for the share plan each year and get it filed on that system by 5th of July. Very important with a SIPP is that you keep a record of all the awards that were made, all the leavers and the reasons for leaving. And the reason you need to have a reason for leaving is you need to make sure you know if an employee is a good leaver or a bad leaver within the terms of the legislation. Do keep records of all correspondence with HMRC, especially if you have agreed a valuation in your company shares before making awards. And of course, the company will need to liaise with the trustee, especially for future awards, including if there's any funding requirements. So, I mean, typically if you're making an annual award each year, the company will write to the trustee and say, we'd like to make this many awards, and then the trustee gets on with it and does it. In addition, the trustee has to submit a trust return and must always be mindful, as I say, that it's been acting in the best interest of the beneficiaries and ensuring generally that it acts in accordance with its powers and duties. And one of the most important aspects there is that the SIPP trustee must not pay more than the market value for the shares, which is why getting that valuation agreed with HMRC can be quite important. I've looked at the time and I've now got approximately 3 minutes to run through my case study, so I will just do this quickly. This is a real life company. Well, they're not anymore because they sold, but it just demonstrates how that the SIPP works. So we had the Heron family, and Heron family owned Heron Limited. And everything was fine and dandy. Nobody particularly wanted to sell. It was a nice family company, but they were thinking about some kind of succession plan. They were very much a family-owned business. They wanted to strengthen like the whole commitment, loyalty thing across the whole workforce, and importantly, they wanted their employee participants to see a clear economic benefit. It was very long-term focused, as I say, no interest in selling particularly, but they did want to retain some interest for the herons, including all the little herons. This is quite an old case study because this sit around for quite a long time. So they set up a share incentive plan and a trust for all of the employees, and they awarded free shares to all of their employees. They used a points-based system, so they measured it on length of service and salary band. And when people left, the shares were recycled through the SIPP trust and used for future employees. And employees were also allowed to sell their shares back to the SIPP, so that was where the financial benefit came from. If there was a new conservatory that needed building, an employee could say, I'm choosing to sell my shares back to the SIPP to cash out some of my shares. And because the plan ran for a long time, that worked very nicely. So the way it worked was Mr. Heron sold his shares into the SIPP, thus reducing his interest in the company. So the SIPP increased its interest in the company, and then we had that regular award of free shares to employees with the ability to recycle and sell by the employees over time. So Mr. Heron's interest went down and the SIPP and the employees' interest went up. It wasn't a very big SIPP plan, it was only about 45 people. So it wasn't huge. It worked really well. They made free share awards each year. They agreed HMRC valuations each year. An HMRC valuation for a SIPP usually lasts about 6 months. They bought shares back at the latest agreed market value as agreed with the revenue. They also had an EMI option plan, which kind of works slightly separately in that an EBT was used as well. So EMI shares bought back by the Employee Benefit Trust. if EMI shares were bought back by the SIP, that kind of put them into a ring fence for all employees rather than discretionary. So they mixed those up a little bit. They paid dividends to everybody. So again, that financial interest. And then a man came to the door with a check they couldn't say no to. So the company was sold. And as a consequence, the ultimate, we've gone from 100% ownership by the Herons to around about a 20% interest for the employees through the SIP and the EMI, and a couple of additional share awards to very key employees over and above the share incentive plan. So the Herons kept their majority interest. All the SIP shareholders sold their shares without any capital gains tax. Most importantly, the owner had done what he'd wanted to do. He'd managed to transfer a decent chunk of his shareholding to his employees over a decent period. He'd kept his staff. It was really good staff retention in that company. He provided with them an economic benefit by way of the internal share market and the SIP, and by way of the dividend payments. And he did tell us that it had had a significant impact on the whole company culture and the reward structure. So his vision had been achieved, and that always makes us happy. It's always sad when, from our perspective, when one of our clients sells, because also then we don't have any more work from them. But it's really good to see a really nice good news story when a share incentive plan or any other employee share plan has delivered the long-term vision of the owner that set it up 5-10 years ago. So that was a really happy ending. So just quick conclusion: if you want all employee share ownership and you want a sense of equitable ownership for your employees, and you also want tax efficiency, I would use the SIP. It's one of my favourite plans. It has a real sense of fairness and the ability for employees really to see a return on shares that they may have received for nothing or may have paid a small amount for. So effectively, that is the end of the seminar. I think I'm just in time. I don't know if there are any questions, because there is a lovely little way of sending questions on this gadget. Let me just see. I think, but unfortunately, from my perspective, they come at very small. So, what is this person saying? Okay. Slides will be available afterwards. Yes, that's fine. Okay, let me see if I can find something. Let's have a little look. So, will any slides be? Yes, I will send slides around afterwards, or they will be on our website. There may be a slight delay because my marketing lady is out of the office, but I will get something to you as soon as I can. Please, can you advise where you would go? Why will you go for SIP rather than EMI? I appreciate EMI could be more selective, and a company may not meet the EMI qualifying criteria. Surely, if you meet EMI conditions, you would go for that. Yes, there's absolutely no reason why you can't use EMI for an all employee share scheme. A share incentive plan is more tax efficient, because even the most tax efficient EMI scheme is going to involve somebody paying an exercise price to buy their shares, whatever that might be. So you can't give shares away for nothing that have value under EMI. And also, when you sell your EMI shares, you will be subject to some capital gains tax, usually, unless you fall within the exemption, because you can reduce capital gains tax on the sale of shares acquired under an EMI to 10%, but it's still 10% rather than nothing. The other thing is that you obviously have individual limits on EMI of £250,000, but you also have a company limit of 3 million. There's no company limit on share incentive plans. EMI options are absolutely fine. You can use them for all employees. You can allow exercise before a sale so people can receive dividends. The main advantage really is you are delivering that complete zero tax rate, and the concept of genuine share ownership rather than an option. Quite often you can do a SIP. Well, you can do a SIP with an EMI top up if you want to do that. There's no reason why you can't do an EMI for all. Can a SIP run alongside an EOT? Yes, it can. So an EOT is a trust that acquires a majority of the shares in a company and holds it on behalf of employees, but that's more indirect ownership. If you want to put in some kind of direct ownership into your EOT company, once it's owned by the employees, you can use any tax advantage scheme alongside it, including EMI and share incentive plans. When a company wins a new contract and TUPE employees come into the company, if the company has a SIP scheme, I assume the TUPE personnel have to be offered shares too. Yes, I think they would have to, depending when the next award was, and depending on whether they'd met that qualifying criteria of 12 months, and presumably if there's a TUPE transfer, they would have their previous employment added onto that. So yes. Let me see. Are shares directly linked with profits? So shareholders share profits in proportion to the amount of shares they own. Well, that's a kind of, I think that's a dividend question. If the directors decide to pay a dividend, then the dividends would be paid to all shareholders on a pro rata basis. If the SIP shares are just ordinary shares that pay dividends in the same way, then yes, it would be pro rata. You might have a different class of shares used under the SIP, in which case you could differentiate between dividends paid in the same way as you can with any other shareholders owning a different class of shares. Or you might have a SIP share that doesn't pay dividends, although I'm not sure if that really is very motivational for an employee shareholder, especially if they've paid anything to buy their shares. Just see if there are any other questions. Could SIP trust be sold to a third party? I don't think a SIP trust can, but certainly a SIP can be part of a third party sale, a transaction of a company. So a transaction sale of a company to a third party. In that case, the shares in the SIP would be sold alongside all the other shares, and the sales proceeds distributed to the employees according to how many shares they have held in the SIP at the time. I think that's what your question means. I don't know how a SIP trust could be sold to a third party. Can't see any other questions. I think I hope I've answered them all effectively. But if I haven't answered them effectively, please do drop me a line. I will arrange for the slides to be sent round after this seminar. As I say, there is should be a follow-up survey from SurveyMonkey. So if you did get had any feedback, that would be really helpful. If you wouldn't mind telling me if you liked the webinar, if you didn't like the webinar, how it might be better. And there are my contact details again if you've got any other follow-up questions. And I very much hope to hear from some of you. Thank you for listening. That's the end of the webinar, and I hope you have a nice day.